Hey everyone, it's Tony Leonardi, your certified financial planner and author of A Smarter Way to Retire, back with another episode of A Smarter Way to Retire podcast. Over the past few weeks, we've been discussing how to be more intentional with your retirement assets. Specifically, the difference between live-on assets, the money that you'll spend during your lifetime, and leave-on assets, the money that you intend to leave to your kids and grandkids, and how important it is to make that distinction between the two. Today, I want to introduce you to an advanced planning strategy called the Charitable Remainder Trust, or CRT. A charitable remainder trust allows you to transfer appreciated assets, such as stocks, real estate, or a business, transfer it into a trust. You and or your spouse receive income from the trust for the rest of your lives, or for a set number of years, your choice. At the end of that period, the remaining assets go to the charity or charities of your choice. Sounds interesting, but why would I want to do something like this? Well, this strategy can offer several meaningful benefits, including an immediate charitable income tax deduction, the potential to avoid or defer capital gains tax on the sale of highly appreciated assets, the creation of a steady income stream for yourself during retirement, and the ability to make a significant gift to charity at some point in the future. 4 potential benefits wrapped up in one strategy. While charitable remainder trusts can be very powerful with those 4 benefits in one, they're not right for everyone. Before we get into who they may work well for, it's important to understand some of the key considerations and potential drawbacks. So here are a few things to consider. These trusts are irrevocable. Once the assets are placed in the trust, you generally cannot take them back. If your financial situation changes, you're locked in. Investment risk. The trust assets are typically invested in the markets to generate income. If investments perform poorly, which they do on occasion, your income payments may decline. Also, complexity and administrative costs. Professional fees for attorneys, trustees, investment managers can be substantial and may erode returns over time, especially for smaller trusts. So 3 very important things to consider: irrevocable, investment risk, and cost. That said, there are certain situations where a charitable remainder trust is often a strong fit. Here are a few examples. If you're selling a privately held business, business owners with a low cost basis can potentially avoid a large capital gain tax bill while creating lifetime income for themselves and or their spouse. If you have expiring or vesting stock options or RSUs, executives with concentrated equity compensation can avoid a large taxable event. How about someone with concentrated positions in employer stock? Longtime employees who want to diversify without triggering immediate capital gains taxes. How about highly appreciated investment real estate? Owners of rental or commercial property who want to simplify their holdings and generate an income stream. Or pre-IPO or private company stock, early investors or employees expecting a big liquidity event. In general, people who have highly appreciated assets want to create an additional retirement income stream and have some level of charitable intent tend to benefit most from this type of strategy. On the other hand, there are situations where a charitable remainder trust might not be the best fit. And these include people who may need access to that principal later on. Remember, a CRT is irrevocable. Smaller estates where administrative costs can outweigh the benefits. This strategy is generally reserved for larger estates or businesses. Individuals who do not have any genuine charitable intents should not be involved with charitable planning, or people in lower tax brackets where the tax benefits are less meaningful. Also, those who need predictable growing income from this asset, since payments can fluctuate based on investment performance. So what happens to the money at the end of the trust term? One of the most common concerns I hear is if a charitable remainder trust means that the remainder of the trust balance goes to charity at the end of the term. Doesn't that mean that my kids or my family get less? Well, the short answer is not necessarily. With a charitable remainder trust, you're converting an appreciated asset into lifetime income for yourself and or your spouse, while also receiving two valuable tax benefits: avoiding capital gains tax and receiving a charitable income tax deduction. In many cases, the combination of higher income and tax savings could actually leave you and indirectly your family in a stronger financial position than if you had sold the asset outright and paid all the taxes up front. That said, the CRT does involve a commitment that the remainder will go to charity. That's why it's so important to model different scenarios to ensure that the strategy aligns with your goals, both for your income, for your retirement, and for your legacy. Let's take a look at a real world example to bring this home. John, age 65, is selling his business. He wants to sell it for $5 million. His cost basis is small, around $500,000. So that means that he would owe roughly $1 million in capital gains taxes if he sold the business outright. After paying the tax, he'd have about $4 million left to invest and live off of. Using the 4% rule, he could comfortably withdraw about $160,000 per year. Now let's compare that to putting the business into a charitable remainder trust. John avoids the $1 million capital gains tax entirely. So the full $5 million sale price goes to work for him inside the trust. Assuming the trust earns a reasonable average return of around 7%, it could pay John 5% per year or $250,000 annually for the rest of his life. That's roughly $90,000 more per year than he would likely have generated in income from the outright sale of the business. In addition to that, John receives an immediate charitable income tax deduction, which can help offset other taxable income for up to 5 years. Of course, this is a hypothetical example and it may not be indicative of everyone's experiences. But here's where it gets interesting. John has 3 good options with that extra $90,000 a year in income. Option 1, obviously, he could keep that extra income for himself and his spouse. Option 2, he can reinvest the extra $90,000 every year into separate investment accounts for his kids. Assuming a reasonable long-term average return of around 6 to 6.5%, that account could grow to $7 or $8 million over 30 years. Money that his children would eventually receive. Option 3, he can use the extra $90,000 per year to buy a permanent life insurance policy. For a healthy 65-year-old who qualifies for good rates, that level of annual premium has the potential to create a tax-free death benefit in the range of $5 to $6 million, or maybe even more, assuming the policy is properly designed, premiums are paid for many years, and the policy performs reasonably well over time. This can be a powerful way to create a significant tax-free legacy for his children, especially if he wants to solve the die too soon scenario, meaning if he sets up the CRT today and dies tomorrow or next year. In all 3 cases, John can get significantly more income during his lifetime while still creating a meaningful legacy for his family. These are advanced planning tools that require careful coordination with your attorney, your tax advisor, and your financial planner. They're not DIY strategies, and they're not right for everyone. But for the right client, especially those with highly appreciated assets, this strategy can be very effective. If you're considering more advanced planning strategies like charitable remainder trusts, I can help you model how they might fit into your overall plan. Feel free to reach out and book a quick call with me. You can book a 15-minute spot on my calendar by going to my website, leonardifamilywealthcare.com, Look for my Contact Me and Calendly links. Next week, we're going to dive into the Charitable Lead Trust. It's almost the opposite of the Charitable Remainder Trust, and that should make for an interesting discussion. So stay tuned for next week. And remember, there really is a smarter way to retire.
Securities and investment advisory services offered through Mosaic Wealth Inc., member FINRA SIPC. Mosaic Wealth is separately owned in other entities, and the marketing names, products, or services referenced here are independent of Mosaic Wealth. The opinions expressed herein are for general information only and is not necessarily the opinions of Mosaic Wealth or its representatives. Investing is subject to risk, including loss of principal invested. Past performance is not a guarantee of future results. No strategy can assure profit nor protect against loss. It is not intended to provide specific advice or recommendations for any individual. Please consult your financial professional, attorney, or tax advisor with regard to your individual situation.